the hegemon is gone. We should not assume that we will necessarily have a smooth transition to whatever's going to come next. During these downturns, you get a migration of debt from the private sector to the public sector. The really unprecedented record levels of U.S. government debt to GDP, inflation, might be the only answer.
I'm very pleased to welcome to the show Dr. William White. He is the senior fellow of the C.D. Howe Institute, and he was previously head of the Monetary and Economic Department of the Bank of International Settlements, BIS. Previously also served on senior positions with the Bank of England, having served as an economist, and also an economist at the Bank of Canada. Dr. White has been warning of the next financial crisis, what that may look like, and how to best prepare for it. We're here to get his take on the direction of the economy today. Bill, it's good to see you. Thank you for joining us. It's an honor to host you today. Thank you for being here.
No, it's a great pleasure to be here. I'm very pleased to talk to you and your audience.
Thank you. I want to start by addressing this article that you wrote for, I believe, the Financial Times. I'll just pull it up here. This was back in 2018. And I'll just summarize it for the audience. I won't read the whole thing. Start preparing for the next financial crisis now. Continuing on the current monetary path is ineffective and increasingly dangerous. But any reversal also involves great risks. It follows that the odds of another crisis blowing up to continue to rise. Now, back then, there was the ZIRP, zero interest rate policy, that has since been reversed. You didn't predict the pandemic, but that was a major crisis that shocked financial markets and the real economy alike. But more or less, since you wrote the article in 2018, how would you evaluate the direction of advanced economies? Are we closer to this financial crisis that you warned about several years ago, or have been warning about throughout your career?
Well, yeah, I think it has been getting cumulatively worse. One of the underlying problems has always been sort of credit finance debt and leverage. And we've had a system really for the last 30 or 40 years, which has basically tried to provide safety nets for downturns, which has prevented debts from actually being liquidated, so that every crisis that you have or any cycle that you have, debts are building up in the upturns, but they're never sort of reversed in the downturns by an equal manner. So the fact is that debt levels have been growing steadily. And the implication is that the crisis associated with debts and leverage, and we've had 2 or 3 of them now in recent decades, is that they tend to become more and more serious with time, because the underlying problems in the economy are getting aggravated over time. So if you think about public sector debt, the deficits always go up during the downturns, but you never see the surpluses materialize in equal magnitude in the upturns. And so the upshot is that the debt levels just keep going up and up. And in the private sector side, it's much the same, but aggravated by the problem that a lot of that debt now is outside of debt owed to banks. It's debt owed to unrelated financial institutions, private credit, whatever. So in a certain sense, we have no sense actually of who owns the debt or who's lent the debt. And therefore, I think the vulnerabilities have been getting larger. And of course, the stock market is something that everybody's concerned about. Now, it's just a symptom of the underlying problem. But the stock market today, as you're well aware, has been rising steadily. And it's highly, highly concentrated in a small number of firms, most of them associated with AI. And concentration is another thing, along with leverage, that always make people feel edgy.
So to your remark about the rising debt levels being a concern, do you think, by the way, the U.S. just clocked in $38 trillion of debt recently. This rising debt, was that a result of zero interest rate policies? Or would that have come naturally regardless of where the monetary policy would have been?
No, I think it certainly owes a great deal to easy money. If you say to a politician or anybody else for that matter, that you can borrow money basically at no cost, it's a tremendous temptation. And of course, people have this unfortunate tendency, I think it's human nature, to extrapolate current positions into prospective positions. So you think you can borrow the money easily today, and you sort of say to yourself, well, I can borrow money easily today and this will go on forever. Why would you ever want to put yourself through the pain of any kind of restraint? So I think it has made a material contribution to the expanding fiscal deficit.
There's this trend of de-dollarization that I want to explore with you in a little bit more detail later. But since you're bringing this up, it just came to my mind. The trend of de-dollarization, do you think that has anything to do with the fact that interest rates have risen over the last few years? And we have to be aware of the fact that emerging markets economies have typically in the past borrowed money using US dollars because it is cheaper than the local currency, but it is now significantly more expensive than it was maybe a few years ago, Bill. So the de-dollarization effort that Eastern countries like China and Russia have led, now the Trump administration wants to reverse that. I wonder if that's one of the reasons why they want to lower the interest rate so other people can want to borrow with the dollar.
No, I think in fact the relatively higher interest rates in the United States really ought to have been supporting the dollar. And the odd thing about it, of course, is that in the course of the last year or so, that in spite of those relatively higher interest rates, the dollar's not got stronger, it's got weaker. And I suspect that the underlying reason for that is that people, well, there's a lot of reasons, not least of which was the treatment of Russian assets during the Russia-Ukrainian war. But I think people have started to worry more and more about the robustness of the US dollar over time and the likelihood that the deficits and the really unprecedented record levels of US government debt to GDP are heralding a period of fiscal dominance in which inflation might be the only answer. And if you were in that set of circumstances and you thought that the dollar would go down in consequence, I think you'd probably try to get out in advance. So I suspect that that's one of the worries, is that the U.S. debt, and of course, Trump's attack on the Fed and the independence of the Fed have made people worry much more about a future debt dynamic that could well be inflationary in the United States. So I don't want any part of it, and I'm out of here.
Gold prices have continuously hit all-time highs this year in 2025. Stellar Gold in the mining industry is a name worth watching. Today's sponsor, Stellar Gold, is a gold developer with two of the largest undeveloped gold projects in Canada, the Tower Gold Project in the well-known Timmins mining camp and the Carlamac Gold Project in the Northwest Territories. They just released plans for the towers and the numbers are impressive. The project could deliver a $2.5 billion after-tax net present value at spot gold price and produce 273,000 ounces annually over 19 years. Backed by a proven management team with a relentless drive for success, Stellar is positioned to unlock serious value for investors. To learn more, go to stellargold.com/David Lin in the link down below or scan the QR code here. And don't forget to read their cautionary statements, forward-looking information, and risk disclosures, which are all available on their website and on SEDAR. You're physically out of there. You moved across the pond. But let's address the crux of this particular article here. An unintended consequence of regulatory reforms has been to reduce market liquidity. Even in the absence of inflationary pressures, financial markets themselves might react in a disorderly way to signals of stronger growth. Sovereign bond yields in advanced economies are at historically low levels where they were in 2018 and are ripe for a reversal. Well, this is rather prescient because they did reverse. Bond yields in the long end of the curve are much higher now than they were in 2018. So what's next?
Well, one of the points I guess that I'd make is that we should not assume that we will necessarily have a smooth transition to whatever's going to come next. I believe that the economy is a kind of complex adaptive system. And it's a kind of system that is subject to tipping points, just like the climate and many other complex systems in both nature and society. And so you can get very sudden movements. And I guess my principal concern at the moment is that one of the principal movements might involve the bond vigilantes coming back, and that you could have a sudden rise in bond prices that would cause a lot of problems elsewhere. And one of the other sort of hobby horses of mine at the moment is trying to point out the fact that the future is likely to be more inflationary than the past, because all of the big driving secular forces that were leading inflation down for many years, virtually every one of those forces is now going into reverse. So that the future is inherently going to be much more inflationary than the past. And the kind of forces that I'm talking about is the demographics. We had many, many years, for example, where you had the baby boomers in the advanced markets. You had urbanization in China, hundreds of millions of people coming into the global market system, the labor coming into the global market system. All that demographics has turned around, not just in the advanced market economies, but also in China, in Korea, in Japan. The working age populations are going down virtually everywhere. So that's going to be a big hit to sort of productive potential. We had years and years of globalization, and China and Eastern Europe coming into global markets, forcing prices down. That's all going into reverse now with the deglobalization, and particularly the tariff wars, which I totally fail to understand. But as I see them developing, excuse me, I see as causing significant problems with implications for prices. We have climate change. We had decades where people wrongly didn't worry about the use of fossil fuels, so there was no impediment to increasing energy supply. Now that's all disappearing. You've got a carbon budget, people having either to protect themselves against climate change or take steps to mitigate climate change. Those things are going to be enormously expensive. We have corporations that used to worry solely about making profit, shareholder value. That's sort of quietly morphing into not efficiency, but resilience. Okay, having to change your supply chains, just aside from the deglobalization, just the recognition that having a totally efficient supply chain where you've got single producers of all the things that you're putting together is a very dangerous way to run your business. That came out of COVID, basically. So there's all sorts of these forces that are moving in an inflationary direction. And that, of course, is going to be another significant force pushing bond yields higher. So there's a lot of factors out there. And then you get to the final thing, which is if you've got a government that's got huge debts and in a way has no other way of dealing with them, debt restructuring is not exactly ideal, austerity is not ideal. The politically expedient way of dealing with it is through inflation. And it's something we've seen forever. And so I suspect that's the kind of future we have awaiting for us. Not only that the underlying factors are more inflationary, but that indebted governments see still more inflation as a way to deal with those problems.
What are the immediate effects of rising debt on the markets themselves? The ultimate concern is that the government will at one point no longer be able to service interest costs. And one of many things could happen, the worst case being a default. Perhaps the bond vigilantes will step in, but you will see significant movement in not just the bond markets, but also the equity markets if, in fact, risk-free debt is no longer risk-free. But that is the worst case scenario. What are the steps that are more likely to happen that the economy will take before we get there?
Well, I think, I've been wrestling with David. I've been wrestling this for ages and ages. But in complex systems, there's no equilibrium. At best, I could say there are multiple equilibria. That is to say, you could tell a lot of stories. One story that I can tell is that as interest rates rise, you will have private corporations in particular who are overextended, whether through incompetence or fraud or whatever. I'm thinking Tricolor and, that kind of thing. One possibility is you can have a kind of private sector problem, which when you think about it would be deflationary. So that, private institutions would stop offering credit, companies would go belly up because they couldn't afford private sector debt service. I see that as a plausible near-term response. And so what that would mean is you'd have a kind of deflationary outcome. But then you have to think about the next step, that if you get into a deflationary situation, the government, which has already got huge debts, virtually all of the major Western countries do, perhaps with Germany and Switzerland as exceptions. In that kind of deflationary environment, the debt service becomes even more burdensome. So if you think about a simple recession, tax revenues go way down, deficits go way up, deficits get bigger, not smaller. And so again, the governments faced with that kind of circumstance, I think will be much more inclined to open the spigots, to start offering more and more guarantees for private credit to keep everything going. And you'll have a repeat of what we've seen repeatedly in the past, is that during these downturns, you get a migration of debt from the private sector to the public sector. Okay? And when that happens, then the pressure is on for still more monetary accommodation. And so you'll get a kind of shift from from a deflationary outcome to an inflationary outcome. And as you know, from looking at the experience of countries in Latin America, oftentimes when the inflation starts to turn, it can turn in a dime. And it can go up very sharply, even as real output is going down. So we've got this kind of near-term, our near-term fixation tells us that the short-term Phillips curve is always alive and well, and that if you get a deflation, that it's going to lead to if you get a recession or a deep recession, it's going to lead to disinflation. That is not necessarily true. So I'm worried about these stages and the fact that they can change quite quickly. And we're not really used to most people are not used to thinking about these phase transitions, a bit like ice to water. And it can happen in these complex systems.
Well, could it work in theory, though, Bill, where sovereign nations are not private entities and individuals? Where if I were to be overburdened with debt and cannot pay it off, I would file for bankruptcy. But a nation state could simply print more money and issue more debt to cover existing maturing debt.
Well, in the old days, of course, when countries, if you read Rogoff and Reinhardt, this time is different. They make the point that sort of prior to World War II, the way out for most highly indebted, advanced countries was to default. And after World War II, before World War II, they were on the gold standard or something akin to the gold standard. So you couldn't print your way out. Okay, you couldn't print your way out, so you defaulted. But since the war and the return to fiat currencies, people have been able to inflate their way out, and that's what they've chosen to do. And I dare say that when the chips are down, that'll be what they'll do again.
Is it possible, though, that GDP will keep up with a rising debt such that the debt to GDP level will remain constant and this will become more manageable?
Certainly one of the solutions to the government debt overhang problem is often touted as faster growth. Okay? But the question then becomes, well, what do you need to do to get faster growth when you know that the debt overhang problem, it's like your credit card's at the limit, that it is fundamentally anti-spending, anti-growth. So the question is, can you make the supply side changes that are big enough? And people talk about AI. It's possible, but it's betting on it's betting on a hope. It's not betting on a sure thing. You've got supply side reforms. I worked at the OECD for many years, and they had a publication called Going for Growth, which is all about supply side reforms that countries could make that would significantly increase their potential growth. Those reforms have been slowing and slowing and slowing. And you see it almost everywhere in the Western world. It's referred to in the UK here as the blob. In the United States, they've got a different word for it. But what it really comes down to is there are so many vested interests now and people wanting to do the right thing, and each fighting for their position in such a way that nothing happens, right? Because there's always somebody whose ox is going to get gored by a supply side reform. And so supply side changes are becoming more and more difficult. So I can certainly see a place for it. But I do remind you that productivity growth, total factor productivity growth has been declining for decades, certainly ever since the crisis, the great financial crisis. The World Bank and the IMF or medium-term projections are all for still slower growth going forward. So to bet on that is a hope, and I hope that, and I trust that hope will materialize, but it might not.
You're an economist for both the Bank of Canada and the Bank of England. If you were working for another central bank of the G7 country today, let's use the Federal Reserve as an example. What would your suggestion be? On the one hand, lower interest rates could help the government issue debt going forward of lower interest costs. However, like you mentioned earlier, it could exacerbate the inflation problem, especially when fiscal dominance is at front and center, and we don't need lower interest rates when there's no austerity, is the argument here. So how would you balance that?
Well, I think that the central bank should realize, and the government should realize, that they have in fact been kicking the can down the road through using lower interest rates to stimulate the economy whenever there has been any kind of a downturn or even a threat of a downturn. But the way in which they've done it, by encouraging that debt accumulation, is making the underlying circumstances worse and worse. So at any stage, one could say, you are making things worse, stop doing it. The problem is that each cycle we go through, going back to the first thing I said in this conversation, if you treat the problem of excess debt, you treat it by issuing still more debt. Okay? What you know is that this path must stop at some time. But at each moment in time, it's gotten worse from the previous cycle. So your incentive to kick it down the road one more time is even greater than it was the last time. Do you follow me? So you're constantly incited to do more of the same. And even with the knowledge that you're just making things worse. So at a certain point, and we may actually be at that point, you can't do it anymore. And then you have to do something else.
And what needs to happen to force both central banks and governments to implement monetary and fiscal policies to dramatically not just reduce the debt, but to cut the growth of the debt? Basically, for example, right, Germany went through a period of austerity because they needed to. What would need to happen before we also see here in the West right now a similar measure of austerity implemented?
You have to remember that the defining historical moment in Germany was the hyperinflation that followed World War One. Okay, and that has left an indelible mark in the Germans. And so when people start saying the problem, we've got a problem, they immediately cast it in terms of inflation's coming back, we got to do something about it. In the United States in particular, and by extension, many of the other Western countries, the defining historical moment was the Great Depression. And so that's what they're always out there worried about. So getting people now to make, forgetting about the severity of the debt problem and how there might be a really near-term concern to do something about it. Even thinking in terms of reducing the deficit is enormously difficult to sell. I'm thinking about, do you remember Jean-Pierre Juncker, who was the head of the European Commission for a while? And also, I think, president of Luxembourg. But he had a wonderful line. What he said was, of course we know what to do. Of course we governments know what to do. What we don't know is how to get reelected after we do it. And you can see this virtually everywhere. In the United States, where there's this kind of antipathy towards any kind of tax increase, even down to not having a VAT because a VAT would be communist, starve the beast. So getting the ordinary person on side to say, we really have got to cut back on things we can't afford in order to pay for the things that we absolutely have to have. That in itself is going to be very difficult. So I'm thinking.
To digress for a moment here, and since you brought that up in terms of political favor, we have here society in certain pockets of the U.S. or other parts of G7 wanting more democratic socialist policies. As you're aware, Zohran Mamdani was just elected in New York City. His platform runs on the promise of free buses, free state-run grocery stores, higher minimum wage. They'll be taxing the rich to finance some of these endeavors. But this was an overwhelming popular policy platform, and he won outright. So people want this bill. What are the effects of this being adopted on a wider scale?
Well, I mean, this is one of the worries that goes back to what I was talking about before, is that we're already at a point where not just governments, but sort of the society as a whole is in a way living beyond its means. And if we have movements that are going to move us even further in that direction, then of course it's increasing the dangers that I've been talking about since this interview began. So that sort of really worries me. It does not worry me that people are concerned about the decades-long accumulation of both income and wealth by the top 1% or 10% of the population. It seems to me there is no doubt that the distribution of income and wealth is one that is not exactly socially optimal and might well not be sustainable. Having said that, okay, if we try collectively to live beyond our means, I fear that we have the dangers of inflation that I'm talking about becoming even more dangerous than I had previously implied. One of the things that when I talk about living beyond our means, one of the things that I am concerned about is levels of consumption, whether it's government-supported consumption or whether it's private consumption relative to investment, which in many countries, the infrastructure has been, governments have allowed the infrastructure to get worse and worse, falling bridges in Baltimore and Montreal. And so we've got the infrastructure problems we have to deal with. We've got the climate problem that is going to take massive investment, whether it's adaptation or mitigation. We have new supply lines that we need in light of deglobalization and all the rest of it. We've got increased investment in defense in order to ensure our political security. So if you start saying things like our potential growth is being held back by many of the reforms that didn't take place and by the changes in objective circumstances like the population growth rate and climate and whatever. And so our aggregate supply, as it were, is limited. But on the aggregate demand side, we really do need significantly higher levels of investment. Then the only conclusion you can come to, right, is consumption has to be squeezed. And it has to be squeezed not because one sort of wants to do bad things to the consumer. It's because without the investment, those levels of consumption are simply not sustainable. So to me, there's a lot of arithmetic here. And I think it was Winston Churchill who said at one point, one cannot argue with arithmetic. One cannot argue with the obvious facts of the case.
Bill, I'd like to draw your attention to Canada now and use Canada as a point of reference or example for our next part of the conversation. So this is a chart that was published by Reuters. It was discussing actually the BIS's warning of mounting debt and the disconnect between mounting debt and stocks, which we've already discussed. But take a look at this chart here. It highlights the debt to GDP levels of several G7 countries: Canada, France, Germany, Japan, Italy, Britain, and the United States. You can see that Canada's debt to GDP exploded throughout the 90s and continued rising beyond its peers, significantly beyond its peers throughout the 2000s. It's forecasted to stabilize somewhat. Coincidentally, and I'm not saying this is a causation, but if you were to look at studies done on Canadian productivity versus the U.S., the Canadian productivity, which had here in blue line, for example, was outpacing the growth of the productivity in the U.S. up until about the early 2000s, in which case, at which time that reversed. Coincidentally, with the rise and the skyrocketing rise of debt in Canada, is there a relationship? And more broadly, why has Canada's debt risen so much in the last couple of decades?
Well, two things. One, I haven't seen this chart before, and it actually surprises me because I guess I thought that the Canadian debt situation was actually relatively favorable compared to others. But if this is what the numbers say, I presume this is all government debt, and I presume it's gross government debt. I think net government debt, those numbers are actually quite different. But anyway, let's go back to these charts. And with my sort of statement, one has to be a bit careful about which numbers you're talking about. But certainly in terms of the productivity growth rates, they have fallen behind the United States. I know Bill Robson at the CD Howe has been going on for ages and ages about the absence of investment in Canada, that is very low relative to the United States. You normally think in terms of productivity levels being related to the amount of investment, particularly sort of in, embedded endogenous technical change and all this kind of stuff. So that certainly would be playing a part. It's the difficulty that the Italians have had, when you think about the European counterparts, that the problem in Italy has not been sort of government profligacy. It's been the fact that the economy has been stagnant for years. So that's certainly playing a part. Most of this, as I understand it, is provincial level debt. And I know that some of the provinces have been a bit more, improvident perhaps than others. But again, as I said earlier on, when you're in an environment where the interest rates are very low and it looks as if your debt service is totally manageable, there's a great temptation to say, well, it's easier to add on to the debt through running deficits and giving people what they actually think they need, or in many cases do actually need, because you don't think you've got a problem. But as I say, it's a tipping point problem. That if you do these calculations about debt sustainability, which is the primary surplus over GDP is equal to R minus G times debt over G&E, so that it's the relationship between R, the interest rate, and G, the growth rate of the economy, that's absolutely central. As long as you have the interest rate low enough, you have no problem at all, or no perceived problem. But what people don't spend enough time thinking about is, but what if the rates have to go up? And then all of a sudden, you've got a big problem.
Well, correct me if I'm wrong, but I believe in 2003 or in the early 2000s, you had urged Fed Chair Greenspan at the time to raise interest rates at a time of credit expansion, at a time of boom. And your rationale at the time was that during times of boom, the government, where the banks in particular, need to prepare for downturns. Would you make a similar suggestion to Fed Chair Powell today?
I was calling for leaning against the wind at a time when it seemed to me that at a time when issues of fiscal dominance and financial dominance, i.e., can't raise interest rates because the private sector can't take the hit, those things were not a big problem. And I didn't want them to become a big problem. And so leaning against the wind, I mean, this is a kind of Austrian, Hayekian sort of approach to things that it goes back decades and decades, that the problem isn't in the downturn. The downturn's a materialization of the problems that were building up during the upturn. So you have to attack the upturn and make sure it doesn't get out of hand, particularly in terms of credit-driven and leveraged debt. So that's what I was doing then. Today, the problems that I wanted to mitigate or to reduce, those problems are now really out there. And if you have a situation where, how can one say, where the debt levels, both public and private, are dangerously high, then having still higher interest rates to lean against them might be the trigger that triggers the downturn that you were really trying to avoid. Do you follow me?
The economy really can't handle higher interest rates.
That's the problem at this point. Is you can't. This is what the BIS used to refer to as the debt trap, which was you can't raise interest rates because the economy can't take the hit. You're back into a debt deflation world like Irving Fisher in the 1930s. So you can't raise interest rates. We had a terrible problem. But you can't lower interest rates either, because it just simply makes worse the problem that you're facing, which is a problem of excessive debt. So you're sort of caught like a rabbit in the headlights, and you have to turn to some more fundamental answer to the problem than the use of macroeconomic tools.
Well, the other issue is geopolitical in nature. Is this the end of globalization as we know it? I believe you said in another interview on another channel, and I quote, "It's a total mess in terms of international cooperation. I don't think in my 50 years in this business, I don't think I've ever seen it worse." I believe you're referring to international trade. Some might agree with you. What is the future of international cooperation and the future of globalization?
Well, my view at the moment is that the China-US conflict is really the major game in town, and that the world has profoundly changed, that the hegemon is gone. I'm not quite sure what's going to replace it, but it is clear that the dominant position that the US had over everything really it's finished. And one way to characterize it at the moment, I think, is that China is really sort of the major power in terms of the real economy, and particularly manufacture of goods. That's basically where the power lies. The US has still got financial dominance. Everything is still basically done in dollars. And I guess what I would foresee, because neither of these countries is going away, is that they're going to continue sniping away at each other for the foreseeable future. And so that the Chinese will try to exploit their control over real things to the detriment of the United States. So they'll say, they'll play the rare earths thing, pharmaceuticals thing, all of the areas where they basically are monopoly producers of stuff that everybody else needs. And the US is going to try to, and of course the Chinese will try to undermine the still dominant position of the US in the financial sphere. And, they're doing all sorts of things that lead one to believe that they're sort of going to be trying to do that. The US will do the very opposite. They'll try to shore up their financial dominance. They'll try to sort of undo the Chinese monopoly of production over things. So, President Trump now increasingly turning to foreign countries saying, we want foreign direct investment in the United States. We want you to promise to do 20 billion in this area and that area. So that's sort of what I see coming down the road. And this is not going to be a world in which it's going to be easy to find a cooperative solution that is to everybody's benefit. It could happen, but frankly, I would be very surprised.
Well, Scott Bessent is warning us of a permanent decoupling between China and the U.S. Well, he said China and the rest of the world, but let's just take China and the U.S. I wonder, though, the old Ricardian theories of comparative advantage, do those still apply today? Meaning if people should trade with one another because you're better at making one particular good versus somebody else making something else better. And then so you should trade given your comparative advantage. But if Trump wants to bring manufacturing onshore, and like you said, China makes everyone's goods and they just make everything, do people still need to trade to increase everyone's standards of living?
Yeah, I believe they do.
Okay.
I mean, the comparative advantage in the old days, I mean, people were really thinking about resource allocations. But today, I mean, when you think about countries like Korea, Singapore, Hong Kong, Taiwan, I mean, these countries had nothing, right? Have nothing in terms of material resources. And they've created sort of progress through ingenuity. But interestingly enough, virtually all of them, that ingenuity showed up in the form of increased exports, a kind of internationally led development program. So I do think that if we find ourselves in a situation where there's material impediments to trade, that it certainly is not going to do anybody any good. And I fear that's how it seems to be developing. There's an odd thing, though. It's something you said that just sparked a thought in my mind. The idea that everybody in the Western world is going to get together with America and basically duke it out with China and whoever goes into the Chinese bloc. Two things against that. I mean, one of them is the U.S. has been bending over backwards to antagonize everybody, not least its closest ally, Canada. And there's increasing talk, I mean, as I read it anyway, of the battle lines are going to get drawn not between China and the rest of the world, but between the United States and the rest of the world. That if the U.S. doesn't want to play, okay, in terms of tariffs, in terms of climate change, world health for that matter, doesn't want to be part of a global community, well, then they can go their own way and everybody else will do deals amongst themselves. And we're seeing more and more attention being paid to that range of territory.
And in
So
that situation, where does Canada's allegiance lie?
I think Canada, by gift of geography, really has but little choice
Yes.
to stay in the U.S. bloc for an extended period of time. But clearly, I mean, there's some issues, climate, for example, tariffs, where Canada obviously doesn't want to be part of the U.S. Dominated group. Um, but I think for a period of time, as Prime Minister and the government knows, is that you're wedded to the U.S. If you start, what's another thing about complex systems, they're always sort of path dependent. So you start from where you are. You can't start from anywhere else. And Canada starts with what, 75% of its exports still going to the US.
Yes, and in that situation, Bill, where the rest of the world starts trading amongst themselves independent of the U.S., what then is a global de facto unit of account or currency?
People will continue to use the US dollar, I think, for I mean, this issue has been debated so many times, is this the end of dollar dominance? It's the boy that cries wolf. We've called the end so many times, and it continues. And I think now with things like stablecoin and the U.S. pushing of that particular sort of approach to digitalization, that's going to be another thing that will sort of help the old regime to continue. Having said that, I think the Chinese, and again, what do I know? But the way in which they have taken big steps to reduce their holdings of U.S. dollars and to increase their holdings of gold, you hear people talking about the possibility that what the Chinese may be trying to do is setting up an alternative currency system based more on the renminbi, not the sort of the BRIC currencies more generally, but on the renminbi. That would essentially be gold backed. And then you'd be back to Bretton Woods before the dissolution of Bretton Woods, but with the renminbi at the center. So I think that's not something that's going to happen overnight. But I've heard people talk about if things go sour with the dollar increasingly, and not least because people are objecting to the weaponification of the dollar, which of course has been going on for decades now, with Russia just the latest example of it, that the Chinese will be ready to, with Plan B, as it were, to fill in the gap.
Well, people have been speculating whether or not the BRICS countries will unify to make their own currency. They've denied it. Even in recent summits, they have rejected this idea of coming up with a BRICS unified currency. I wonder, though, if China will spearhead some sort of movement to have their own euro area with other BRICS members at some point. And have a common currency in that capacity. Do you ever see a second euro area in the Far East? Is that something in the realm of possibility here? Does that make sense?
Well, I see a range of possibilities. I'm reminded of a conversation that took place many years ago at the G10 in Paris when I was there, and it was all about the idea of trade barriers. And the euro had turned itself into a kind of, at the time, sort of fortress, as it were, with a common external tariff, et cetera, et cetera. And the question came up about whether Southeast Asia would do the same. And I remember the Japanese delegate sort of coming out with a great many reasons why this wasn't going to happen, sort of practical reasons. And then his final comment was, "Oh, and don't forget the war." That there were still sort of so many people who in Asia who had bad memories of the Japanese occupation during the war. Well, I think the current situation is there are still many what's the word, international problems in Southeast Asia. I mean, these cultures are widely diverse, and many of them have huge historical memories of conflicts with their neighbors. So I'm thinking about Cambodia and Burma and or Myanmar. Japan with all the others, China and India. I mean, even in Southeast Asia, the people that might be sort of part of a BRICS-led area, maybe more willing to work together. But getting in bed together is a different thing, right?
Well, I just on that note, let's talk about the Eurozone itself. I've heard from a few people, some people even living in Europe, that it is rather fragile, this alliance right now, especially considering how Germany is in a recession, and you brought up climate change earlier. Germany's auto sector is basically at war with environmental regulators because people just aren't buying electric vehicles, and they're at serious risk of being overrun and potentially even going bankrupt, some of these companies. So what is the future of, well, I know I brought up a few things here, but how do we as a governing body here, I'm talking about the European Union, implement climate fighting solutions while not hurting something as powerful and important as, let's say, the German auto industry that employs maybe 10% of the population overall and contributes to a significant part of European GDP?
Germany made a lot of bad bets. One of them was excessive reliance on Russia for cheap gas. Another one was excessive reliance on China for export markets. And I guess the third one is excessive reliance on the US for security and defense. And all of this stuff is coming unstuck. So there's no doubt that they've got some significant problems going forward. And you're quite right to point out the fact that climate change is perceived by many people as being costly. And certainly for the car companies, they were slow off the mark. And now I think are basically trying to, well, I mean, it's perfectly natural. I mean, if they're all geared up or still excessively geared up to produce petrol engines, then clearly they've got a disadvantage. And the Chinese model of innovation and production is in fact one that works on the government provides guidance as to industries that they want to support. And that includes EVs and, automobile companies and solar and all the stuff associated with climate change. And these various companies then fight themselves to the death, which they're doing at the moment, which means everybody's losing money, okay, as they fight to the death, until finally 2 or 3 companies wind up getting market dominance and then spread that dominance through the rest of the world. And that's what the German and all the European car makers are confronted with at the moment. That the Chinese automobile industry is producing cars in a way that makes them extremely competitive. And how do you deal with that?
Here's maybe a controversial thought. Why don't we lower the tariffs or eliminate the tariffs on Chinese cars altogether, import the cheaper Chinese EVs, and that would reduce emissions globally significantly if people will want to buy them. That's a big if. I'm assuming there's demand for these cars. Yes, car companies will be put maybe out of business, but we fix the overall issue here of lower emissions.
Well,
what do you think
I think
of that
overall
sacrifice?
it maybe again it's sort of back to the debt problem as well, is that you can't have solutions that, what's the word? If you're worried about tomorrow and your solution demands killing the patient today, well, there's no point worrying about tomorrow. So that I think whatever kind of solution we find to these problems, there's got to be one that is sort of that uses time to minimize the costs of adjustment. That it's the rapidity of the adjustment that causes the problem. In any event, I dare say that any nation, however concerned about the world's welfare, including through climate change, is not going to destroy itself in the interest of helping everybody else. So
Yeah, I understand.
in Germany, I suspect what will happen is that they will raise tariffs on EVs, and it will not help the climate change thing. But having said that, we've always been confronted. I mean, you even think about sort of solar, okay, or wind, where Western companies were making the running on these things for a long period of time. The Danes, particularly in terms of wind power. And then along came the Chinese with production that was subsidized in various ways and this competition model that encouraged innovation. And now we all have a big problem. And on the one hand, we say, well, just let in the cheaper stuff. It's good for it's good for the climate change. Indeed, it is. But,
That is the dilemma. I want to finish our conversation on changes to major asset classes, given everything we've discussed so far. So the U.S. dollar, let's segue into the U.S. dollar. The DXY has been lower this year. It's stabilized somewhat since the Liberation Day tariffs were announced in April. What is the future of the dollar? Can we continue to see weakness or strength ahead?
Well, let me go back again to complex adaptive systems. In complex adaptive systems, forecasting is literally impossible. Okay, so what I'm going to tell you is it's an impossible task. With respect to currencies, I think it's a particularly difficult because who used this phrase? It's who's the dirtiest shirt in the laundry is what it comes down to. That virtually all of these countries, other than Germany, which of course through the euro is now subject to the problems associated with France and other countries, okay, they've got big debt problems. All of these countries share the same problem. So I've been sort of wrestling this for ages because when you think about the fiscal dominance story and you sort of try to use a Latin American currency problem as an example, at a certain point, people see the writing on the wall. Okay, fiscal dominance, inflation, situation's going to get worse. I'm out of here. But the question is, when everybody's in the same situation and everybody's the dirty shirt in the laundry, where do you run to? Okay. And I suspect that in part explains the massive increase in the price of gold. People are saying, plague in all your houses. I'm going to go into something totally different. So I really don't know. I mean, at the moment, I think that what's the word? That the shock, the shock hit to trust on the U.S. side might be greater than it is elsewhere. That, people just never thought about the dollar being really at risk. And once that sort of thought hits the market, and starts to grow, they may have a vulnerability. The excess of trust in the future turning into a realistic assessment of the future value of the dollar, that may be bigger in the case of the dollar than others, but what do I know?
This is the long-term chart of the U.S. 10-year yield. Structural bull market for bonds in the last 45 years, as you're aware. Yeah. They have reached, the bond market has reached an inflection point around 2020. I wonder if you think that there's structural macro forces at play that will propel bond yields much higher, such that we have a return of this of much higher yields as was seen in the late 70s and 1980. And actually, if you see that this chart kind of goes back to the 1930s, the long-term bond yield is close to where it was back in the 60s and before. So it does seem to go in these multi-decade cycles here.
Yeah. Yeah, I think the room for nominal yields to go higher is probably greater than people anticipate. Particularly all of the thoughts that I was giving you about prospective inflationary pressures, secular pressures towards inflation, and the fact that the governments want it. I'm not saying they want it in itself, but they see its usefulness as a means of dealing with a debt service overhang problem that they can't otherwise handle. So I suspect that there's more room on the upside than people currently anticipate.
Very good. Thank you
Again,
very
I
much.
go back to my point about complexity. Who knows? Who can say?
I want to finish off with this final question here. What are you looking forward to in terms of future economic developments or technological developments that may have the best potential, let's put it this way, to increase our standards of living, to increase labor productivity, and potentially even increase real wages?
Well, I mean, AI is the obvious candidate. But as many people have pointed out, the previous technological revolutions, you think about steam, railways, electricity, these things totally transformed our lives. Rates of growth of productivity, human welfare. AI might well do the same, but it's not going to happen overnight. And it will take probably a decade or two before we get the full benefits. But my big worry, even on that front, is that like the internet boom at the beginning of the 1980s, is that there will be so much investment that goes into it that doesn't have a near-term payoff, and therefore results in big problems for the companies that are at the forefront of the revolution. We might have some dangerous sort of disinflationary problems before we get to the other ones, and before we get to the increase in real output that this thing might be capable of over time.
Well, this is actually subject of great debate, whether or not technology, especially AI, is long-term disinflationary, depending on how you see it would impact the labor force and ultimately output. And I wonder if this will offset your worries for higher inflation going forward. We'll end it here.
Well, it could well be. There's a lot of forces in play. A lot of forces in play.
William, thank you so much for your time today. Where can we learn more about you and potentially follow your work?
Well, everything that I do that's in the public domain is up on my website, and it's very simple. It's www.williamwhite.ca.
You lucked out on that domain. That's a great URL domain. So please check out the website. I'll put the link down below. Follow Bill there. Thank you so much, Bill. I enjoyed our talk. I hope you can come on the show and visit us again. Thank you.
Well, it was a pleasure, David. Thank you very much for asking me.
Thank you for watching. Don't forget to like and subscribe.